Here's 3 different time frames of the exact same chart. One is bullish, the other 2 are bearish. Which one would you trust? Because if you keep trusting the wrong chart, you're going to be losing relentlessly to the point you may as well quit trading now. I know, because that was the exact spot I was in. It wasn't until I reviewed hundreds of my own trades, noticed a pattern, and then managed to pass over $2.5 million in funded accounts. So in this video, I'm going to break down why you're trusting the wrong chart and which one you should trust instead. So have you ever looked at a chart and thought this is definitely a buy? Then switched time frames, actually maybe it's a sell, then switched again, now I'm not really sure. That doesn't happen because trading is difficult. It's because you're treating every time frame as if they deserve the same amount of trust. Some time frames are just incredibly misleading. So how do you know which ones are actually telling the truth? Well, imagine you're a detective investigating a murder. The killer walks up to someone on the street, attacks them, and then runs away. 3 different witnesses saw what happened. One watched the entire thing unfold from across the street. Another only looked up just as the victim hit the floor. The third one saw someone sprinting away afterwards. Now, would you treat all 3 of these witnesses equally? No, of course not. The witness who saw the entire event has 2 things the others don't: the bigger picture and context. They didn't just see what happened, they saw why it happened. Maybe there was an argument beforehand, maybe it was a robbery gone bad. Maybe the victim actually chased the attacker first. Those details completely change how you interpret what happened, or whether a crime even took place. Charts work exactly the same way. Every time frame is looking at the exact same market, but they're not all seeing the same information. This 1-hour chart shows prices pushing strong bearish. But zoom out to the daily, and that bearish move is actually a tiny pullback inside of a much bigger bullish move. Nothing has actually changed here. It's still the same chart. The lower time frame simply couldn't see the bigger picture, which is why you need the higher time frames. That's what's going to stop you from reacting to moves that only look important because you're so zoomed in. So stop treating every time frame equally. Some deserve your trust far more than others. At this point, you might be thinking, okay, well, if higher time frames are so much better, why don't I just trade those and ignore the lower time frames altogether? Well, let's say you go ahead and you only trust the higher time frames. Great. You now know where the market is likely to go, but now you have an even bigger question to answer, and it's one the higher time frames cannot help you with. When do you actually enter the market? When do you take the trade? Knowing the destination isn't the same as knowing when to get on the train. And if you ignore the lower time frames altogether, you'll either enter far too early or you're going to miss the move altogether. Let's refer back to our murder scene. You decide the witness who saw everything is the most reliable witness. So naturally, you'd build your entire case around them and what they told you. Cool. But would you completely ignore the other 2 witnesses? No, you wouldn't. Sure, they didn't see the whole thing, but they did see their small part. And they were much closer, meaning they could see things in more detail. The witness who only saw the killer running away might have seen which direction they ran afterwards, whether they got into a getaway car. The witness who only saw the victim fall might have noticed the killer drop something, or they exchanged some words beforehand. This is very important information to help us solve the murder. And again, trading works exactly the same way. The higher timeframes tell you where you should be looking for trades. The lower timeframes help you zoom into that area so you know exactly when and where to enter. So what does that actually look like on a chart? Well, let's say I'm looking at this daily resistance. My strategy tells me this area has a high chance of pushing price lower. Great. But I'm not just going to blindly sell the entire resistance. Instead, I'll zoom into the 4-hour chart. Now I can see that price actually respects this small section of this resistance far more than the rest of it. Do you see that? Do you see the reaction we're getting when price taps into this specific part of the resistance in comparison to the rest of it? So instead of selling somewhere inside this huge zone where there's a lot of empty space, a lot of dead space, I'm selling from this exact area instead. That precision is only possible because I use the lower time frame. So don't think of higher and lower time frames as competing with each other. Think of them as a team. The higher time frames give you the story, the lower time frames give you the details. And that leaves us with the single most important question we're yet to answer. Which specific time frames should you actually be using? There are dozens of time frames, from the 1 second to the 45 seconds, to the 3 minute, to the 2 hour, to the daily. The issue is, most traders pick time frames like they're making a sandwich, picking literally any filling they like, from chocolate to tuna, and hoping everything somehow fits together. Shockingly, tuna and chocolate don't go well together, and neither do a lot of time frames. In fact, some combinations leave massive gaps in what you're seeing, which can make trading essentially impossible. So I'm just going to give you the exact framework I've used to reach millions in funding. First, the monthly time frame, always. Okay, I always start here. It is the biggest time frame I use, making it also the most reliable time frame. Using anything larger is simply too zoomed out for day trading. It's like trying to watch our murder happen from the 80th floor of a skyscraper. You can see the big picture, sure, but you've lost way too much detail to the point you're barely a witness anymore. I'll do my analysis here, and then I'll move down a time frame to the weekly. The weekly will support what the monthly just told me, but because it's slightly more zoomed in, it gives me new and more detailed information. For example, if I draw this monthly resistance like this, I can then go to the weekly and just ensure it's accurate. I can adjust it a little bit. I can see what price has done over the last week and what it's likely to do this week. And most importantly, I can see which levels are really, really important, like this one. Week after week, this level is respected, and yet it does not show up on the monthly. Okay, we would have missed it if we only relied on the monthly. Next comes the daily. Now we're even more zoomed in, so we're getting close enough to start planning the trade itself. In fact, I'll use certain levels on the daily specifically to identify my TP levels for that day. Where does price actually have room to move towards today? And with that, that's the higher time frame picture complete. Now I switch to the 4 hour, and this is the golden time frame. I'll spot about 90% of my trades here, and there's two reasons for that. Number one, the 4 hour is still a high enough time frame where it remains very reliable in comparison to the 5-minute or the 15-minute. Number two, we can get multiple 4 hour candles every trading day. That provides us opportunity. Put simply, it is the best of both worlds. Okay, so from there, I'm just asking myself, what is market structure doing right now? I'm trying to figure out the direction of the market in the short term. And then simply, can I use what the higher time frames told me to make this trade really high quality? Can I enter from one of those refined higher time frame levels like I showed you before? They're the majority of the time frames that I'm using. Occasionally, I will drop down to the 1 hour time frame, and that just allows me to enter trades when a market is moving very quickly, too quickly for the 4 hour, for example. Approaching your charts this way means you're no longer taking a trade because one chart looked good. You're taking the trade because 5 different perspectives support the same idea. Every time frame that agrees with your trade removes a little more doubt and adds a little more quality to the trade. That's how you stack probability in your favor, and that's why this framework has become the backbone of how I analyze every single chart. But the thing is, this does only solve half the problem. Even if you're looking at the right time frames, if your strategy isn't very good, you're still going to be losing trade after trade. So watch this video next. I'll show you the only trade I use to go from an Uber Eats delivery driver to a full-time trader. I'll see you over there.